So everyone, thank you so much for taking time out of your busy day. Listen, we know tax season is just around the corner. I know with my firm, my team has already been preparing for it, and it's been a lot of fun stuff as well. So today, my dear friend Eric is here. Eric is, you know everything about IRS representation, it seems. It seems like you are the go-to source, and I'm just so thankful that you're here with us today to explore some of these common tax season mistakes that can be made to trigger our not so favorite thing, which is IRS enforcement. And of course, that can, stipulate going into audits and collections. And so really today is about avoiding those kind of, potential headaches. Let's just face it, it's not a potential headache. It's a bloody huge headache if this happens. So let's really kind of get into that. I am over the moon excited to have our partnership with Tax Rep Network and Mr. Eric Green that's on here. So we're here to provide you with as much education that you need to battle these IRS different changes and regulations and all of the stuff that's happening most recently, which Eric is going to give us a lot of information on, because I feel like you're right there in the room, Eric, when they make these decisions. I don't know, but I feel you are that fly on the wall. Okay, so you're tax expert today, obviously with requires no introduction, is Mr. Eric Green. Eric, I am just going to shush right now. I'm going to remove myself from the main stage, and I'll be back here to support you. Everyone, have fun today. Remember, ask those Q&As in the Q&A.
All right, Jenny, thank you. And thank all of you for joining us today for what is usually a pretty popular program, and the timing, as Jenny said, couldn't be better. One, for the program, but two, I just recorded a podcast literally yesterday with Jenny and Matt from Ignition. The time to implement this is now. And the Ignition solves a huge headache of mine, which was we get phone calls and we would send a letter. The client never signed and came back. We never followed up because we're too busy. And at the end of the year, I have all of these, usually around 30 on average, potential clients that never crossed the finish line. Well, when we know the average rep matter is around $8,700, I can sit and do the math and think we left $250,000 on the table. And I don't know about you, it's nice to generate $1 million of revenue, but I'd really rather generate 1.2. So Ignition solves all that. It will automatically follow up. It lets us know when people read the letter, when they sign the letter, when we get paid, so we can get started. So go check out the podcast episode. And as Jenny mentioned, next Monday, the 15th, Don Brolin and I are going to be looking at utilizing Ignition to handle all the correspondence with the IRS and other stuff. Again, one CPE and CE credit are available for that. That will be next Monday. So anyway, in terms of today, I'm Eric Green. That's what I look like. I don't think we need to read my bio. I don't want to waste any time with that. Just know that we have a 25-person law firm, and the focus of my practice is civil and criminal taxpayer representation, and I'm the founder of Tax Rep Network, and we can skip all of that. So what is in Ignition right now for representation? Well, all of our material and our letter to clients on voluntary disclosure, tax liens, and notices of deficiency are already loaded in. We are working on adding several dozen more. All right, so stay tuned. For those of you using Ignition, those will populate into your templates and letters in Ignition. If you're not using Ignition yet, highly recommend you consider jumping in, because all of this stuff you won't have to draft. It is there for you. And as I mentioned, it will automate the process for you, as well as the fact, by the way, as an aside, you should not be filing tax returns until you've been paid. Now, if you're sitting there going, well, wait a minute, Eric, time out. I don't know what I'm owed until after I've done the return. No, but I bet you know 95%. It's last year plus whatever your increase is. that money should be taken upfront before you start working. Yeah, there might be the extra Schedule E or something like that you're going to bill afterward, but you should have 90 to 95% of your revenue in after those returns have been filed. All right. If you tell me that, in October, the last 2 weeks of October, you're trying to get your billing done, something's wrong. Okay. It should not come to that. Okay. So let's talk about common tax season mistakes, which I'm going to skim over because those are the ones that I'm assuming none of us are going to make, but I'll just point them out to you. I also want to talk about what our requirements are. What are we supposed to be considering as preparers? What is our obligation? I want to talk about non-cash contributions. These, by the way, are all of the hot button issues, all right, that the government has on their radar. And there's one that I did not mention here, and that is reasonable comp. If you have S Corp clients, that is a big deal right now. So to the extent we have time, I'll mention that. But non-cash contributions, hobby loss issues, innocent spouse issues, balance due on the return, earned income tax credit. For those of you who have clients who claim the EITC, I'm doing a workshop actually tomorrow on this. They are going after preparers left and right, and the penalties are huge. So I want to just walk you through what should be happening, right, in your office, both before tax season and during, and then finally mention the foreign forms, the international filing forms. And of course, we all know there are huge penalties there. So the common mistakes. And if you're using software, hopefully you don't have this issue because you're rolling forward good information. If you have bad information, you're rolling forward bad information, and we'll keep making this mistake. Misspelled names, misspelled dependents, ID numbers that don't match, bad addresses and transposed numbers. You have no idea how often the ID numbers and the transposed numbers trigger bad audits. A significant portion of audits get triggered because of bad information, which is why they were so hype on the e-filing, because often those bad numbers were from the IRS's own input during tax season. You remember they used to hire tons of seasonal help, they might still, and they sit there and they would type in, they would input all the information off the returns. With preparers now e-filing, that has taken away most of that. That doesn't mean there might be a bad number, but if you have a new client, make sure that somebody else, a second set of eyes, looks at the input before you hit send, just to make sure everything is correct. The last thing you want to do is have a client get audited because something was transposed or an ID number didn't match. And by the way, once that audit gets triggered, that doesn't mean we just fixed that and we're good. They're going to start looking at everything else. And the client who, let's say, ends up having to pay is at some point going to consider the idea of whether they can go after you for it. So the big deal here is for especially new clients you're inputting into your system, please make sure the input is correct. All right. A couple other things. You want to have a signed engagement letter with your client. You better have the e-filing authorization on file. All right. And like I mentioned, clients need to pay before. I don't know about you. I like getting paid. And if I'm not going to get paid, frankly, there's a lot of other stuff I could be doing than free work. So what you want to be doing right now in the next few weeks, first of all, make sure that your engagement letters are updated. Your price increases are there. Right? I don't know about your world, but in my world, everything seems to go up every year. The rent, the utilities, my staff want raises for some random reason. I don't know why. The supplies, everything goes up. Why are you the exception? All right. So you want to make sure your engagement letters are up. You'd be amazed how often people raise prices, but they don't fix the letter. And I've had taxpayers call me and say, well, my letter said X and they're trying to charge me Y. I'm sorry, but you probably don't have to pay Y. You probably only have to pay X because that's what the letter said that they sent you. So unless there was additional work. those e-filing authorizations, the IRS still audits for those. All right. And if there's an innocent spouse issue that arises, lawyers like me are going to come calling looking for them, because what I'm looking to do is blame you. My client never even signed the return. The accountant, the CPA or EA, can't even produce the e-file authorization. How can you hold me responsible when it seems to me clearly the dirty spouse, along with the CPA or EA that was conspiring with them, filed this on their behalf? So first of all, make sure your letters are updated. Make sure you have an internal process that nothing gets e-filed until that authorization is on file. And also, again, automate everything. If you're using Ignition, it'll take care of this. Make sure you get paid. And if you don't know what you want to get paid, last year's fee plus your increase is a good place to start. Other things that will produce enforcement. Now, I bring this up because there are more than 10 million non-filers. Anyone who's been listening to me for the last 2 years knows the statistics. More than 15 million with a balance due, more than 10 million non-filers. Starting in January, the IRS has flipped the switch on the automated enforcement. For those of you who've not seen this yet, my tax rep members are reporting to me a huge, huge upswing in the CP 504s, which is that threat to levy. Those notices it's now raining, those notices. We've also seen a lot of CP 516s, which is the request for missing returns. When you get a non-filer and that non-filer comes in, or even if it's not a non-filer, someone comes to you and they think they have everything. For instance, you usually will get at least last year's return, if not several years. You might notice that there was a 1099 before, but they don't have it now, or a W-2, they don't have it now. Now, you ask the client, 50-50, the client's going to give you the right answer because the client really has no idea what's going on. It's not a bad idea to pull wage and earning reports from the IRS, get a power of attorney. You can do the 8821 or 2848. I prefer the 2848 myself. Upload it to CAF. We have tax help software. We will pull transcripts. That will show everything reported to that taxpayer. Why is this important? Well, first of all, if you don't, you'll trigger an audit, whether it's the automated under reporter or it actually gets sent to the field. The other thing for non-filers, nobody wants to prepare the last 6 years of returns, which is what you have to file for a non-filer. Compliance is defined in the Internal Revenue Manual as the last 6 years. So if you have a new client come to you who has not filed since they got back from Vietnam, no, you don't need to do 48 years of tax returns. 18 through 23 will get you into compliance, and that's all the IRS wants. You can file more if you want to, but you don't have to. Nope, and I've done this. Nobody wants to get the returns prepared, submit them, and have the whole thing get kicked back because there's a mismatch. You're missing a W-2. You're missing a 1099. The client will not be impressed. The revenue officer will really not be impressed. It's easy enough to just get the wage and earning reports. And there are some other business reasons why you want to have power of attorney. Potentially, you can look for first-time penalty abatements on your clients and actually keep a percentage of it. It's allowed as a contingent fee under Circular 230. You could also monitor your clients' accounts for a fee, and flag for them if they get picked up for audit or they're now in collection or whatever. So you want to try to make sure, especially with the non-filers, because their record keeping, in my experience, is not exactly stellar. It's better to make sure we have everything. The easiest way to do that, let's put it this way, we may not have everything, but I want to at least have what the IRS has. All right. So easiest thing to do, wage and earning reports. 2 ways to do it. The client can, 3 ways. The client can walk into the IRS walk-in center and request them. The client can attempt to pull them through the IRS website, or again, with a power of attorney. You can get some of them through e-services. I just find tax help software and we get everything. Account transcripts, wage and earning reports, return transcripts, if we need those to see what was on the return that was filed by, let's say, a bad preparer beforehand, whatever. Beware. Beware the client that comes to you and all of their expenses are nice, even numbers. I had a client referred to me, and the CPA only said, Eric, I don't want to get into it. I took one look at the return. The person did their own return and is now being audited. The CPA looked at the return and basically said, you need to go see an attorney. So the client shows up now pretty ticked off. I don't understand why I'm here, like rotten attitude. I take a look at the Schedule C. Do you notice anything? All the expenses, nice round numbers, 12,000, 15,000, 1,500, 1,000, 40,000, 4,000, 3,000, 3,000, 2,500. What are the odds on every expense being a nice, even round number? Do you think the IRS knows what the odds are on all of the expenses being nice, round, even numbers? These are estimates at best. This is a guaranteed trigger for an audit. So I immediately recognize, yeah, I know why you're being audited now. And the lesson here, okay? Now, under Circular 230, for CPAs and EAs, we all fall under, aside from our own standards, right? The CPA standards of tax practice, the NAEA's model rules, we all also fall under Circular 230. What Circular 230 says, as well as, by the way, the NAEA standards and the AICPA standards, they all say the same thing, which is we are not required to audit our client. In other words, you don't have to require your client to come in with all of their backup and effectively conduct an audit. Now, I will tell you privately, my own return, I upload everything to my CPA, and I upload everything. All of my canceled checks for charitable donations, receipts, everything, which, by the way, I know makes him a little nuts. And because every year he's like, Eric, I don't need all this. Here's my thought. One, while I'm doing this and I have everything, now he has it. Their firm has it. If I get picked for audit, I'm not dealing with it, all right? Because I do not want to be emotionally involved in my own audit. They have everything that backs that up. I'm going to let them deal with it. It's just a way of me making sure everything is in one place. They have it. And this way, in 2.5 years, I don't suddenly have to start looking for this stuff, in my files. It's all there. But you don't have to do that. However, we cannot ignore obvious warning signs. This is a warning sign. This just seems strange. I'll tell you another case. I had a CPA friend of mine called me up. Now, this is probably going back 6 or 7 years now. Called me up in March. Special agents just left his office. They came in asking about a particular landscaper, client of his. And the landscaper would come in every year with one of those green ledger sheets and just had written down, supplies, gas, oil, whatever, truck. And he prepared the return based on that. My client was actually just being viewed as a witness. They wanted to see all of the records that backed up. And basically, they wanted to interview the accountant in terms of how he prepared the returns. By the way, if special agents ever show up in your office, do not speak to them. Thank them, take their card, say your lawyer will be in touch, and do not talk to them. They are not your friend. They're trying to figure out if you're involved in this. If special agents show up, they're not there to try to figure something out. They believe they have enough information to know that false returns, that a crime has been committed. So when they show up, they're trying to figure out who's guilty. They're not your friend. Do not try to explain. You don't want to deal with them. Take their card, say thank you very much, Your attorney will be in touch with them. You don't want to speak to them. Now, if they come with a search warrant, you have to let them in. One agent, by the way, will be sitting with you, hanging out with you. They're going to try to speak to you. That is intentional. Do not talk to them. Call the attorney and just shut your mouth and stay out of it. All right? Because in attempting to explain, you might put yourself in hot water. Anyway, get back to the story. I told him I want to come over that evening, pull everything you have on this client. And we do. Sure enough, we go through all the backup. One year he had transposed two numbers. It was like $90. It doesn't matter. He freaked out about it, but they're not there over $90. But I noticed something really interesting. This landscaper over 8 years went from doing about 250, 300,000 to 1.2 million of revenue. Right? Each year growing, more equipment, more whatever. But I also noticed their labor costs like never moved off 20,000. And so I said to the CPA, I'm like, how is he getting $1.2 million of work done if he only has $20,000 of labor, which is like part-time one person? Sure enough, he had a number. I told the CPA, I'm like, he has people off the books. He's paying cash. And what they want to do is they want to see what he gave you to make sure you're not involved. Because I can assure you, when they showed up at his front door, first thing he said is, oh, I gave my CPA everything. I don't know why it's not on the return. They're going to try to throw you under the bus. And if they don't think of it, trust me, there's going to be a lawyer who's going to be whispering their ear to try to throw you under the bus. And sure enough, that's what happened. They came in, they looked at everything. I asked them point blank. I'm guessing there are some people off the books that we didn't know about. And I knew one of the special agents who smiled at me and said, we can't discuss it, but something like that. But he did make a comment. He said, I'm just wondering why your guy, meaning the CPA, didn't ask how he was getting all this work done. And I said, you know why? Because the guy shows up in like the first week of April when this place is chaotic. All right. And he's taking the numbers, putting them in. Guys making money, paying taxes. Nothing jumped out at him as bizarre. If he had done his books or something like that, that's a different issue. But the point being is we can't ignore things that should be obvious. And a prudent person just looking at it would say, that's weird. Again, we're not required to examine our own clients, but we can't ignore implications of information provided that we either know, have reason to know is inaccurate, incomplete, inconsistent, or suspect is untrue. We are allowed to disclose questionable positions. And I do want to just mention that for a minute, but a couple things here. Number one, let me give you a situation. It's October 15th. Your client did not receive their K-1. They're missing a K-1. And we've all been through this. But if we don't file the return, there's a 25% failure to pay penalty. 25% failure to file penalty. And no one wants to pay a 25% penalty. A couple things. First of all, the penalty is only if you're underpaid, right? All your taxes should be paid in by April. Now, we all know clients who don't know squat about what they make, and they don't pay until they have their return done. That's not the way they're supposed to do it. So there are a couple things you can do here. Number one, they can just pay in, a large chunk of money if they have it to make sure that they're not going to be underpaid. In this way, they can file the return when they have the accurate information. Two is they can file the return without it and disclose it. We're missing a K-1, and the way you disclose, there are two different disclosure forms. 8275, right, is simply where we're providing more information. That would be kind of like where we are now. We're missing a K-1. We don't have the information. We're filing the return without it. We will file an amended, complete, and accurate return once we receive it. This won't prevent an audit, but what it will prevent is from their going after you as a preparer. Because if you submit that return knowing that K-1 is missing, you're filing an inaccurate or incomplete return. We both know that there's no fraudulent intent, but you don't want to be in a pitched battle later with the government. Now, 8275R, the one on the right, that is where we are actually disclosing we're taking a position contrary to the IRS guidance. I always thought that, honestly, guaranteed that these would trigger an audit. I have been involved in drafting and filing these probably 4 or 5 times in the last decade. None of them were audited. And I filed both, 8275 and 8275R. So it's not a guaranteed audit. But this idea, I got to tell you something, we have this all the time in criminal cases where I talked to the accountant. The accountant said, well, yeah, I knew we were missing information, but we could always go back and amend it. I'm like, great. When did you amend? Can you get me the amended return? And you know what they would say? Oh, well, yeah, we didn't. No one ever does. Yeah, we can amend it later and fix it. No one ever does. Client leaves the office. Now it's Thanksgiving, then it's the holidays, then it's tax season again. No one ever thinks to go back and fix it. So don't file returns that are inaccurate or incomplete. Oh, so I told you there are 3 options. One, of course, would be just make sure they're hopefully overpaid so there's no penalties, and then file it when you do have the information. 2, file it explaining we don't have everything, but we'll fix it when we have it with the 8275. The third option is refuse to file it. You're not going to win any kudos with your client there. So I'm inclined to go with the 8275. I have discussed this with Karen Hawkins, who's the former head of OPR. She and I did a podcast together, and that would be her approach. She said, if you do the 8275 and disclose it, OPR should not get involved at all because you've done everything you could. Right? So I think that's probably the smarter way to go. Now, again, it won't prevent your client from having the underpayment penalty. So again, if they can pay in enough to maybe even be slightly overpaid, not a bad idea. Not every client can do that, but still not a bad idea. Now, e-filing. One thing I want to mention to you. If you e-file and that return gets kicked out for some reason, the IRS, if you refile it within a few days correctly, there'll be no penalties. It's automatic. What you can't do is wait 7 months until the bill starts showing up for the client to then realize it wasn't accepted, go fix it. For those of you who are doing a lot of returns, and I know the moment October 15th is done, the moment April 15th and October 15th is done, everyone wants to get the hell out of the office. I would urge you, somebody, I don't care if it's a staff person, I don't care if it's you, needs to go back and just confirm all the e-filed returns were accepted. Now, you can go into the system, see that they've been quote unquote accepted, and still have the IRS claim that one didn't go through. But if you have those screenshots where they were accepted, I can guarantee you will get out of any penalties. I've done this a number of times. I don't want to call them out, but CCH a number of years ago had some blip happen. We must have gotten a dozen taxpayers calling us and CPAs. They had the proof that they had e-filed and it showed accepted, and the IRS waived all the penalties. The point, though, is if it shows that it wasn't accepted, you don't have an excuse of, well, I thought it was accepted. It's on you. All right. And again, clients can go after you for the penalties, not the tax and the interest, but they can go after you for the penalties. You want to make sure as a practice point, somebody goes and looks and sees that the returns that were e-filed were accepted. Now, things that may trigger an audit anyway. Okay. So if your client has income over $200,000, the chance of being audited just goes up. It goes from about 1.3 to about 3.2%, all the way up to about 25 to 30% if they're making more than 10 million, which I'm sure most of your clients are not. But here in Connecticut, we have some towns where that's not uncommon. Westport, Greenwich. I have a number of planning clients who make well north of $10 million. I have one where they have their corporation, they're close. They have an IRS audit team there permanently. So, there are some folks that are going to get audited for no other reason simply than their income level. but often non-cash charitable contributions and cash businesses. So the way that this works, if the client donates $250 or more, they're supposed to have a contemporaneous written acknowledgement from the organization. You've probably seen this, the letter that comes from whatever organization saying, thank you for your donation of $300 that we received on May whatever, right? Now, if it's more than $500 but less than $5,000, the IRS requires Form 8283 Section A to be attached to the return when it goes in. If it's greater than $5,000, meaning the amount of the deduction they're claiming for this non-cash contribution, what we've seen generally is artwork, automobiles, real estate. They're supposed to have a qualified appraisal that is dated within 60 days of the actual donation. If you have clients that are wealthy and this may be something they're considering, this is a good thing to send out to your clients saying, look, if you're considering making a sizable charitable donation more than $5,000 and it's non-cash, if they're sending a check, that's whatever, fine. We just need the canceled check, and then we get the letter from the organization. But if it's real estate, a car, artwork, jewelry, I guess, I don't know, they need to have a qualified appraisal. A letter from the organization is not a qualified appraisal, right? We've litigated this where people donated artwork, and the director of the museum gave them a letter saying it's worth $400,000. That's not a qualified appraisal. Qualified appraisals are usually like 30, 40, 50 pages long. They've got all kinds of other similar artwork and what they sold for and when, and et cetera. I mean, it's a whole analysis. What do you do if your client didn't do this? Now they show up, right? It's April, and that guy Eric Green said it's supposed to be within 60 days, and that was like 5 months ago. We blew that. Have them go get one anyway. Send them out to go get a qualified appraisal. Get the qualified appraisal, submit it with the return. Now, I know it's not within 60 days, but I will tell you, where we've done this, only one got picked for audit. We went, of course, they tried to deny it, the auditor. We went to appeals accepted it. 6 months, it was a piece of real estate. Real estate didn't swing that much. They accepted it for what it is. All right. So there is a rational basis for this. The government can't really give you nothing. The auditors will try, but they really can't. The point being is it's good if your client actually tells you. Make sure they get that written appraisal within 60 days of the actual donation. If they don't, have them go get the qualified appraisal anyway. Now, in the hobby loss arena, for those of you I do a whole program on hobby loss, issues. Code section 183 basically says that if you have losses for 3 out of 5 years, or if it's a horse breeding activity, 7 out of 9 years, there is a presumption that this is a hobby, not a business. That is a presumption. It will. What happens is the burden shifts to the taxpayer to now prove that they're actually in this for profit. And there are 9 factors the government looks at. Again, there's a whole course on this. If the point being, if you have a client who has losses year after year after year on their Schedule C, Schedule E, it could be a partnership, S Corp. This applies to everything but C Corps, because the losses in the C Corp are suspended up. They're up in the C Corp. They don't impact the rest of the 1040. If you have that, what I would suggest, you have to sit down with your client and go through the 9 factors, because we may be able to help the client document this properly, because I'm going to show you the client's not documenting it properly. Go through the 9 factors. You don't need to win all 9 factors. You just have to win enough of them, 3 or 4, to show that they're pursuing this as a business with a profit incentive, that it's not just a hobby. So if the client comes in and you notice this is the third year in a row that they've had losses on their Schedule C, I would tell them, look, we're looking at a potential hobby loss audit here. Let's put you on extension, make a payment if we need to make a payment, put you on extension. I'm going to go on vacation. When I come back in May, you and I sit down. By the way, you're going to pay me for this. Let's go through the 9 factors. Let me help you make sure we have all of our documentation together. So if we do get audited, we can defend the losses, because if they come in and they knock out those losses, often what's going to happen, we have income, we have penalty and interest, but that income is now going to affect other things on the return, right? How much medical deduction they can take, et cetera, et cetera. I think all of you understand that. So I said Schedule C, but remember, it's anything other than a C Corp. So it could be an S Corp. It could be a partnership, Schedule E, Schedule C, doesn't matter, right? It could even be a trust. The only thing exempt from these rules is a C Corp. Now, I mentioned this earlier. The client that comes in, they're not sure they have everything, especially if they're a non-filer for a number of years. Make sure you pull wage and earning reports, all right? Make sure you pull wage and earning reports and have everything, and do not file a return that you know is inaccurate or incomplete. We can always amend is BS, baloney, all right? Because I've never seen anyone actually go back and do that, all right? You can always do the 8275 and explain that you're missing information, and you will file a complete and accurate return when you receive it. Now, gross receipts. Gross receipts, let me just explain something. Often your clients will do their own state sales tax returns. This is a huge mistake because they usually don't know what they're doing. So I'm just going to explain something to you. Now, if you're doing the sales tax returns, I assume you know how to do them properly. So I think we're all good. If you're not, you want to get copies of them when you do the federal return. Here's why. Federal gross receipts, let's call it a Schedule C right now. Schedule C gross receipts must match the gross sales on those sales tax returns. The way sales tax works, and I've not done all 50 states, but I've done enough, they all pretty much work the same. You start with gross sales, and then there are deductions for non-taxable sales. So if it's one of those, like, the little mini mart with the gas station here in Connecticut, everything there is taxable except milk, bread. I think that's about it. All the snacks, candy, soda, cigarettes, they're all subject to tax. So what you would have is, let's assume it's $100,000 of gross sales, and $10,000 is the non-taxable. So it'll be $100,000 reported. Then you have deductions to get to the taxable number that the tax is calculated on. What taxpayers often do is say, well, I sold $100,000, but $10,000 is non-taxable, so it's only $90,000, so they only put $90,000. The problem now is the IRS comes in and says, we have $1.2 million, $100,000 a month times 12 months, but we only have $980,000 reported. Ooh, audit. And the states come in. Most people are afraid of the IRS. I got news for you. My experience, the states are far worse. They are much more aggressive. They are much nastier to deal with. They do not have all of the taxpayer protections that the IRS does. And often reopening things is almost impossible with a state. With the IRS, you have audit reconsideration, doubt as to liability offers. You could pay and seek a refund. Florida, there is no audit reconsideration. If you miss your appeal, it's final, and you're stuck with it. Connecticut undid their audit reconsideration. They did away with it. just to make it more difficult for people to challenge a bad assessment. So if you're not doing the sales tax returns, please get them and review them quickly before you hit the send button. If nothing else, you can tell the client, look, you're doing these wrong. You need to amend the sales tax returns, because if these don't match, it's going to be an automatic audit from the state. Now, the earned income tax credit, I'm doing a whole workshop on this tomorrow for 2 hours. So if you're interested in this, also, by the way, bring all your staff, because we're going to make sure everyone gets their education, which is one of the requirements. If you're going to do an earned income credit tax return, meaning taxpayers who are submitting and getting the earned income tax credit, there are a number of things that you need to do. You have to make sure the checklists are done. Any additional inquiry with that taxpayer must be noted in the file, whether it's physical or electronic. All right. You have to have written procedures in place. You need to be able to prove that all of your folks were given education on dealing with the earned income credit. That's why we started this workshop we do every year, so everyone can walk out with their certificate and you're good to go. When they come in, they don't go after the taxpayers. They're going after you. And right now it's $560 for each violation. And if they find it in 1 year, they're going to open up all 3 years. We have actually seen, I'm going to show you an example if you do join us tomorrow in that case study, where they went after them. I think it was $35,000 or $40,000 in penalties, the preparer. So it was 78 returns, right? 500 at the time, it was like $500, and they did all 3 years. So I think in total it was like 128,000. I think is what they went after. This is a big deal. All right. So if you're doing EITC, you need to make sure you have everything. The backup that the client gave you that justifies the EITC must be in the file. You can't have it in storage, even though nothing's changed year after year. It's got to be in the current year file. You have to prove that that your folks have been through education that year, a course. You have to have written procedures on the EITC. You've done the checklist and you've documented any additional inquiry, and you filed the form, was it 8867 or whatever it is with the EITC, that you filed the forms. If you meet all those, you're good to go. Most people do not. And I spend a lot of time representing accountants up at OPR. So, joint liability. Very quickly, the natural filing state for a client is married filing separate. The couple elects to go joint. What you need to understand is once that election is made, you cannot amend out of it. They're stuck. So if you have clients and you prepare returns and there are going to be balances due and they can't pay them, you should sit and do the CIS, which is the collection information statement, the 433 analysis, to see what collection is going to look like. I know what you're thinking, Eric. It's October 15th. I have no time for that right now. And I agree. When in doubt, file the married filing separate. Here's why. Let's say they come in and there's a balance of $50,000 on the return because they sold something and they spent the money. Can you guys just pay this? No. Okay, look, it's October 15th. I'm going to file you married filing separate. When I come back from my vacation in a week or so, we're going to get back together and look at collection. If we determine you're better off joint, then we can always amend to go joint. But if I file you joint right now and we determine you're better off separate, you're stuck. The only way out of it, all right, is through innocent spouse, and that is not easy to get. Why would they be better off? Well, for instance, I'm self-employed. My wife is a W-2 cancer researcher at NYU. She's tenured faculty. If I don't pay my taxes, why would I want to do a joint return, right? And drag the house, which is in her name for malpractice reasons, her retirement, her 401k, everything else into collection. So even though the balance might be higher on me, I might be better off because I might be an offer candidate. You don't know until you do that analysis. So when you're up against the deadline, It's very flip for me to say, well, just sit and do the 433 RCP analysis. We all know in tax season, no one's got time to do that. Either put them on extension, or if you can't, because you're up against the October deadline, married filing separate. You can always meet with them, do the analysis, and amend to go joint. Just understand if you file joint, there's no getting out of it and they're stuck. Final thing, you need to find, do they own virtual currency? Do they have foreign assets? Make sure you have an affirmative yes or no from them. Why? We get approached every year for someone to sue their accountant because the accountant didn't tell them they had to file in Form 926 or a 5471 or whatever. For collection, which we do a lot of, we actually have their yes-no answers, and they must be answered. My staff know we will not do the work until we have a yes-no. Because if I have special agents show up on an offer and compromise we filed saying, why didn't your client disclose that virtual currency? I'm going to pull up their response where it says yes, no, and say, they said no. Go after them. Make sure that your clients respond to this yes or no. Do not let them leave the organizer blank. All right? In a way, we're trying to protect them from themselves, but you also want to protect yourself. So I know I'm going to be handing off back to Jenny and folks at Ignition. Some important reminders. We can save a lot of time. Get your engagement letters out to your clients. Set up Ignition now, all right? Automate this process. Get paid for your work up front, all right? And again, our templates are in there and we're adding more all the time. For those of you who want to join us tomorrow for the EITC class, 2 hours, 2 credits, please do. And if you're not using Ignition yet, but you're a future user and want to check it out or start a trial, I've given you the links. But with that, I'm going to hand this back to Jenny and company.